Welcome. In this video, we're going to discuss process costing, another formal costing system which stands in comparison or in contrast to job order costing, which we discussed in the last chapter. Now, before we go any further, let's take a moment to kind of review all these costing terms that have been introduced. For example, if we're talking about job order costing and process costing, what are we talking about? We're talking about a formal costing system that depends on the underlying production technology, whether it's a job shop or a flow shop. Another set of costing concepts that we have is actual costing versus normal costing. Well, what does that refer to? That refers to whether we use actual numbers as opposed to budgeted numbers when we calculate any predetermined or budgeted overhead rates. We also have concepts such as absorption costing, value chain costing, throughput costing, direct costing, variable costing, so forth and so on. These have to do with what resources are going to be included, or the consumption of what resources are going to be included in the cost of a cost object. So for example, absorption costing says that the only costs that we are going to assign to the cost object are manufacturing costs. Value chain costing says we're going to capture cost or resource consumption throughout the entire value chain and assign that to the cost object. So now that we've clarified some of those costing concepts, let's get back to the issue at hand, process costing. First, as we saw in the last chapter, in job order costing, we have a situation where we have discrete products that we can go out and identify, and we assign the various manufacturing costs, this is absorption costing, to those different job orders. Notice that we have one work in process account, and that's a master account, and all the subsidiary documentation in that work in process account would be all the various job orders that represent production that has been started but is not completed. That represents our work in process inventory. Now contrast that to process costing. Once again, we're still working with absorption costing, which means what? Which means only the manufacturing costs are going to be assigned to production. But notice here that we cannot identify specific products, so we don't work with job orders. Instead, what we're going to do is we're going to assign costs to the amount of work that's done in our various processes. Notice also that we have a sequential process here. In other words, process A will absorb or have costs assigned to it, manufacturing costs assigned to it, and then process A will float into process B, which will flow into process C, which is the last process in this example, and then that moves on to our finished goods inventory. Likewise, for each one of our processes, we have a work in process account. Okay, now we're going to look at a comprehensive illustration of process costing. In this case, we have a defense manufacturer that makes components for military machines. It has one category of direct costs, direct materials, and one category of indirect costs, which are conversion costs. This is the norm in process costing. That is, we don't have a separate cost category for direct labor. Direct labor is combined with our indirect costs into a conversion cost category. In this particular example, every product here, and notice that the product is identical, passes through two departments, an assembly department and a testing department. Now, what determines how many cost pools we're going to work with in a process costing scenario depends on when those resources are added into the production process. The general common scenario is you have materials which are introduced at a discrete point in time, and then conversion costs which are introduced uniformly throughout the process. In this illustration, we have only one type of material that's added at the beginning of the assembly process. With respect to the testing process, materials are added at the end of the process, and all of the conversion costs in each of the two processes are applied uniformly. Be aware that we could have a situation where we had direct materials introduced at two or more discrete places in the production process, in which case we would have to have a cost pool for each type of material that was introduced at a separate point in time. Okay, just as we did with job order costing, before we go any further, we want to make sure we get a good understanding of what our costing system looks like, and it's very useful to do that visually as we've done right here. So we have two departments, they're sequential. We begin with an assembly department. Materials are added at the beginning of the process. That would have to be the case because if you didn't add materials at the beginning of the process, there'd be nothing to work on. Anyway, those materials are processed uniformly, and then once they reach the termination of this department, they get transferred over this department, and conversion costs are added uniformly, and we have some additional type of materials that are added at the end of the process, and then that completes the manufacture of these products, in which case they're transferred out to finished goods. Okay, in job order costing, the primary documentation we worked with was a job order cost sheet where we simply accumulated the different costs that were assigned to that job order, direct costs being traced to it, indirect costs being allocated to it. In process costing, the fundamental document is a production report. Now, I've had students always ask me if it's necessary to actually learn and use this production report, which I find to be kind of a strange question, because what you always want to be doing in accounting is understanding what is happening operationally. Well, what's happening operationally here? We have units we have to account for. Where are those units? We have costs to account for. Where are those costs? That's exactly what the production report does, and it does it in a very straightforward manner. So if you understand operationally what's happening, the production report will make perfect sense. Okay, so the first step is to determine the units we have to account for. Well, what could those possibly be? It could be whatever was already there, our beginning inventory, plus any units that we start. All right, where can those units be? Well, there's only one of two things that can happen. Either they get finished and transferred out of that department, or they're still there in ending inventory. Likewise, with costs, we do the same thing. We determine the costs we have to account for. Well, what are those costs? They're the costs associated with any beginning inventory that we might have, and they're the costs that are added during the period. What happens to those costs? Those costs are assigned to the units, and we already determined that those units, some of those units were transferred out and some of those units are ending inventory. So we cost those units, and that's how we account for these costs. Now, while this may look different than job order costing, and in fact may even look more complicated, the fact is we're doing the exact same thing in a macro sense, and it's actually easier in process costing than job order costing. So in a macro sense, what are we doing? How does any costing system work? Well, we accumulate costs into cost pools or cost categories. That's what we're going to do right over here. Then we have to allocate those costs to the cost object. In order to do that, we have to select cost allocation base. We'll talk about what that is in a moment, but it's some measure of production volume. So this is a volume-based system. Then we take those allocation rates and we assign those costs to production. Now, I said this is easier than job order costing. The reason for that, as we'll see, is because my products are identical. Each product uses the same resources. We don't have the problem that we have in a job shop where we have different type of products making different demands on resources. So once again, what are we doing here? Operationally, units to account for, where did those units go? Cost to account for, where did those costs go? And then we have to calculate allocation rates for each cost pool we have in our production report. Each column represents a cost pool. How do we determine how many cost pools we have? That has to do with when those costs are introduced into the production process. So the typical situation is you have direct costs, which are introduced at a discrete point in time, and you have your conversion costs, which are introduced uniformly. Okay, units to account for, units accounted for, cost to account for, costs accounted for. As I said before, this is a volume-based costing system. Now, we do introduce one new concept here in process costing that doesn't exist in job order costing, and that is the idea of equivalent units. Equivalent units will be illustrated subsequently in this illustration, but conceptually, the idea here is that we're going to express production in terms of, or partially completed work in terms of fully completed work. In other words, if I have 100 units that are 40% complete, the amount of work I did on those units with respect to any given resource is the same as fully completing 40 units. We use this concept, for example, all the time in higher education. We have something called full-time equivalent. we use this in order to get an idea of what our capacity utilization is. Let's assume, for example, we have a university like CSU Pueblo that has a capacity for 5,000 students, and all of those students are going to school half-time. Well, that is equivalent to half that capacity going to school full-time. In other words, when we're trying to get a handle on what our capacity utilization is in the university, we don't look at the number of students enrolled, we look at full-time equivalent. Okay, so let's begin our illustration here. So it's in the first period, our beginning units our units in beginning inventory are 0. We begin 400 units and we have 0 units in ending inventory. The direct material costs that are incurred or added during the period are $32,000, and the conversion costs added during the period are $24,000. Now, the fact that we have no change in our inventory levels means what? It means that any production we started, we finished. Okay, first step, units to account for. Well, what's the possibility there? We could have some units in beginning inventory. In this case, we have none. We can have the units we started during the period. In this case, it's 400, so we have 400 units to account for. Where are those units? Well, they can only be one of two places. They can either still be here, in this case we have no ending inventory, or they could be transferred out. Units to account for, units accounted for. All right, so we operationally know what's happened to our units. Now what do we have to do? Same thing with costs. What are the costs we have to account for? Well, do we have any beginning inventory costs? No, because we didn't have any beginning inventory. Did we incur any costs during the period? Yes, we incurred material and conversion costs, a total of $56,000. The next step is we have to account for those costs. How do we go about doing that? Well, we need to calculate allocation rates, which is what we'll do right here, and then we need to assign costs to the production, wherever that production is. In this case, 0 of that production remains in ending inventory and 400 of it is transferred out. Okay, so this process right here is where we calculate our allocation rate. Conceptually identical to what we were doing in Chapter 4. We're using a volume-based costing system where our cost allocation base are equivalent units. So the first thing we have to do is calculate the amount of work we did during the period expressed in terms of fully completed units. Well, in this particular example, what happened? We fully completed 400 units, so with respect to materials, how much work did we do? The equivalent of fully completing 400 units. With respect to conversion costs, the same, the equivalent of fully completed 400 units. So these are our denominator level amounts, the amount of production volume that we're going to use. What's the total amount of cost incurred for this cost pool? $32,000. What's the total level of work that was done? 400 units. That gives us an allocation rate of $80 per equivalent unit. For conversion costs, we accumulated a total of $24,000. What's the production volume that went through that in this period? With respect to conversion costs, 400 equivalent units. That gives us an allocation rate of $60 per unit. That gives us a total allocation rate of $140 per completed unit. Now that we have our allocation rate, what do? We allocate these costs to these products. Well, we have 400 units that were fully completed, fully processed during the period and transferred out. So we're going to take those 400 units at the allocation rate of $140 per unit. So that's $56,000. We have no units in any inventory, so there's no cost there. And there's our $56,000, which accounts for the $56,000 that we needed to account for. Now, what this illustrates is the process of using a weighted average here. Well, what does that mean? That means we take all the costs during the period, we look at all the volume that flowed through that with respect to resources consumed in that cost pool, and we come up with a broad weighted average. Okay, let's move on to a second case. We're still in the first period. We have 0 units in beginning inventory. We begin 400 units, but in this case, we get less work done during the period, and we end up with 225 units in ending inventory. Notice that the amount of materials added during the period are exactly the same as they were in the previous example. However, the amount of conversion costs incurred during the period is less than it was in the previous example. Now, does that make sense? Yes, it does. Why? This is the same as it was before because direct material costs are added at the beginning of the period. So the same amount of work was done in this example as in the previous example with respect to direct materials. However, conversion costs are added uniformly during the period, and not all 400 of these units were completed. In fact, only 175 of these units were completed during the period because 225 remain in ending inventory. Okay, step 1, units to account for. Nothing's changed. Units accounted for. In this case, we got less work done. We have 225 units in ending inventory. They're 100% complete with respect to materials. They're only 60% complete with respect to conversion costs. We've got 175 units that were fully completed and transferred out during the period. That fully accounts for the 400 units that we needed to account for. Okay, the next step here would be to calculate the equivalent units for these units accounted for. The 175 units were fully processed both with respect to materials and conversion costs in the current period, so they are equivalent to 175 units each. The 225 units in ending inventory, they're fully processed with respect to material, so they're equivalent to 225 equivalent units, but they were only 60% processed with respect to conversion costs. So 60% of 225 units is equal to 100% of 135 units. So these 225 units in ending inventory that are 60% completed with respect to conversion costs are equivalent to 135 fully completed units. That gives us the total volume for this cost pool of 400 units and the total volume for this cost pool of 310 equivalent units. The next step is we have the costs we have to account for. What are they? There are beginning inventory costs, and they're the costs, we have no beginning inventory costs because we had no beginning inventory. We had costs that were added during the period, which total 50,600. All right, so if we take the amount of costs accumulated in the cost pool, divide it by the cost allocation base, which is equivalent units, we get our allocation rate of $80 per equivalent unit with respect to materials and $60 per equivalent unit with respect to conversion costs for the same $140 per fully completed unit. Now, would you have expected these rates to stay the same? So think about that for a second. What's going to determine my rate is going to be two variables. One is my productivity and the other is my input cost. So let me use a simple example to illustrate this point. Let's assume you were trying to get a handle on what your gasoline costs were on a monthly basis. So let's assume that you normally drive 1,000 miles a month. Your car gets 25 miles a gallon. So how many gallons of gas will you need? Assuming your productivity stays constant at 25 miles a gallon, you'll need 40 gallons of gas. Let's assume that gas costs $3 a gallon. So the total amount of cost that you're going to incur to drive those 1,000 miles in your car that gets 25 miles a gallon is going to be $120. If we take that $120 and divide it by the 1,000 miles that we drive, we get a cost per mile of 12 cents per mile. All right, let's assume in another month you only drive 500 miles, but your productivity is exactly the same, and the input price, the cost of gas, is exactly the same. Well, if I only drive 500 miles at 25 miles a gallon, I'm only going to need 20 gallons of gas. And if I'm still paying $3 per gallon, I'm going to spend $60 in total on gas to drive those 500 miles, which again gives me a rate of 12 cents per mile. So assuming that my productivity is constant and my input costs do not change, then my rates are not going to change. This is a big difference between process costing and job order costing. When you think about process costing in a flow shop, think about continuous production. Your productivity is going to stay pretty constant. In a job order shop, which is demand driven, productivity can be wildly fluctuating. Okay, now that we have our allocation rates, what do? We're going to allocate these costs to these products. Well, the 175 units that were fully processed in the period, they're going to be allocated $24,500 worth of cost. And the 225 units in ending inventory, they are going to be allocated $18,000 of material costs. Why? Because those 225 units in ending inventory are equivalent, the amount of material work we did on them was equivalent to a full 225 units. $8,100 are going to be allocated to ending inventory for conversion costs. The 225 units in ending inventory were only 60% completed, which is the equivalent of fully completing 135 units. So there's the cost of the 175 units transferred out. There's the cost assigned to the 225 units in ending inventory. Total cost accounted for, total cost to account for. So this example illustrated the concept of equivalent units, which is going to happen anytime we have partial production. That means we've got work that we start and we don't finish. How do we measure how much work was done? If I start 100 units, but I only get them 75% complete, how do I do any type of system where my cost allocation base is units of production? I can't use 100 because those 100 units are not fully done. So what I do is I convert those 100 units 75% complete into 75 units 100% complete. Okay, moving on with our example. We're now in the second period. So notice that the ending inventory of period 1 becomes the beginning inventory of period 2. In other words, the 225 units, how do we know we have 225 units? Because in the previous period, that was our ending inventory. Here's the cost assigned to those 225 units. In this period, we begin 275 units, and we have 100 units in ending inventory. Here's the amount of material costs that's added during the period to work on all the stuff that we work on, and here's the amount of conversion costs incurred during the period to work on everything that we work on during the period. Okay, first thing we need to do is understand what's happened to operationally, what's happened to the units. So in this case, in the second period here, we've got 500 units to account for. 225 were already there, 275 that we started during the period. Where are those 500 units? 400 were transferred out, 100 still in ending inventory. So there we have accounted for our 500 units. The next step, the next macro step, is determine the costs we have to account for and then account for those costs. Well, the costs we have to account for are any beginning inventory costs that we might have. The $26,100 of beginning inventory cost was the cost assigned to ending inventory last period, and then we incurred this amount of material cost and this amount of conversion cost during the current period. So we've got a total of $62,280 of cost we have to account for. How are we going to do that? Well, we're going to calculate allocation rates. In order to calculate those allocation rates, we're going to need to determine what our equivalent units were, how much work was done with respect to every cost pool that we have. That will allow us to calculate the rates. And then we're going to take those rates and we're going to assign costs to our production, the 400 units that were transferred out and the 100 units that are still there. Okay, so the next thing we need to do is calculate our equivalent units. For the 400 units that were fully processed in the current period, they're equivalent to 400 units with respect to our two different cost pools. The 100 units in ending inventory were only 50% processed. So they're fully processed with respect to direct materials. Why? Because materials are introduced at the beginning of the period. They're only 50% processed with respect to conversion costs. Now, what would happen if instead of materials being introduced at the beginning of the period, let's assume that materials were introduced at the end of the period. What would this number be right here? It would be 0. Let's assume that materials were introduced at the 40% mark in the process. What would this number be? 100. Let's assume it was introduced at the 50% mark. What would this be? It'd be 100. What if materials were introduced at the 60% mark? What would this be? It would be 0. So you start to get the idea. Materials are introduced at a discrete point in time. Conversion costs are introduced uniformly throughout the process. Okay, so we've got our costs that we've accumulated. We've got our amount of equivalent units for the amount of work done during the period, and this allows us to calculate our allocation rates. So notice that our allocation rates are lower than they were in the previous period. What does that tell us? What can we conclude about that? So when we're working on stuff in accounting, it's not just how do we go about doing this? Here's a number, we calculated it. Take the time to look at the number, try to interpret it, try to analyze it. In the process of doing that, you will start to truly, really deeply understand what's going on. So in the previous period, that was $80, and that was $60, and that was $140. In the second period, these allocation rates have changed. What does that mean? That means that as we said before, there are two things that are going to affect a rate: productivity and input costs. What can we conclude about productivity and or input costs? We can't identify whether it's productivity or it's input costs, but collectively we can conclude that they have gone down in the second period. In other words, to make something in the second period costs less than it did in the first period with respect to materials and with respect to conversion costs. Now, we'll see in a moment when we look at FIFO. FIFO has to do with cost flow assumptions, but for now we're working with the weighted average method. What that means is we're taking all the work that happens and assuming that it occurs essentially in the same period. In other words, we're mixing together what happened with regards to our beginning inventory with what happens in the current period. So the fact that these are weighted averages between the two periods, given that fact, what can we conclude about the actual rates in the second period? Are they going to be higher, lower, or equal to these amounts right here? In other words, this is an average between what happened in the first period and the second period, just as this is. Well, if we know that in the first period the rate was $80, and we know that the average between the first and the second period is 75.6, then what we can conclude is that whatever happened in the second period, the rate was lower than the average of 75.6. Okay, once we have our rates here, we will use those rates to assign these costs that have been accumulated in these cost pools to this production right here. Well, we have 400 units that were fully completed during the period. That's $52,000 assigned to those units. We have 100 units here in ending inventory. They were fully processed with respect to materials, and they were only 50% processed with respect to conversion costs. So there's our total ending inventory cost. There's the cost of goods transferred out, total cost accounted for, total cost to account for. Okay, now we're going to look at FIFO. FIFO is another cost flow assumption. FIFO means first in, first out. Other common cost flow assumptions would be LIFO, last in, first out, HIFO, highest in, first out, so forth and so on. What this means in practical terms is we are going to keep track of what happens in different periods rather than assuming it all happened at the same time, which is what we do with weighted average. Now, before we actually look at this, here's a question. FIFO is a cost flow assumption. It's an assumption about what my cost flows are. Is it possible to have an alternative cost flow assumption? Would it be possible to assume LIFO in process costing? No, the answer is it's not possible to assume LIFO because LIFO assumes last in, first out. And it's not physically possible to have a last in, first out when you have sequential manufacturing. The first thing into the system, the first thing onto the conveyor belt is going to be the first thing off of the conveyor belt. So the actual physical flow of the product through the system in a flow shop is FIFO. Okay, first step, units to account for. This is the second period. The only difference between this and the previous example is we're now assuming FIFO instead of weighted average. So the units to account for are exactly the same. The units accounted for are the same. But here's a difference. Previously we said we had 400 units that were completed and transferred out. Here we're keeping track of the fact that of those 400 units, 225 came out of beginning inventory. That's what would have been finished first and transferred out first. And then we had 175 units that were started and completed in the current period. And then we have the same 100 units in ending inventory. So physically what's happened here in the previous example is no different. 400 units were transferred out. Here we're simply keeping track of the fact that what was transferred out came out in two inventory layers, my beginning inventory and what was started and completed. In weighted average, we didn't bother to do that. We just said 400 units were transferred out. Right, units to account for 500 units, units accounted for 500 units. All right, here's another thing that we do different from weighted average. Our beginning inventory costs are not treated as though they happened in the current period. In other words, we don't mix together what happened in the last period, that relates to our beginning inventory, and what happens in the current period. We keep those things separate. So we incurred we had a beginning inventory cost of $26,100. We need to account for that cost. Where'd that cost go? And during the current period, we incurred an additional $36,180. So it's the same $62,280. Everything is physically and operationally the same as before. It's just that now we're keeping track, more accurate track than we were before. We're not simply taking a weighted average. We're keeping track of what happened in a previous period that relates to our beginning inventory and what happens in the current period. Okay, next step, equivalent units. Well, the 225 units in beginning inventory, they're 100% completed with respect to materials, so we didn't do any work on them with respect to materials. Those units were only 60% completed with respect to conversion costs, so in order to finish the units, the 225 units I have in beginning inventory, what do I need to do? I need to finish converting them, and what remains is 40%. So 40% of 225,000 is the amount of work I did, was equivalent to fully processing 90 units. 175 units started and completed in the current period. All the work was done on them with respect to every cost pool in the current period. And then my ending inventory, I have 100 units in ending inventory. They're fully processed with respect to materials, and they're 50% processed with respect to conversion costs. So my ending inventory is not impacted here by whether I'm using weighted average or FIFO. The units transferred out is. Okay, so now we come down here and we determine what our rates are for the current period. This is the amount of work we did with respect to materials. This is the amount of work that we did with respect to conversion costs. This is the amount of cost we accumulated in our material cost pool. This is the amount of cost we accumulated in our conversion cost pool. And here's our rates. So let's analyze these rates. Let's interpret these rates and analyze them and see if this makes sense. Remember, in the weighted average example that we previously looked at, that was $75.60, and this was $54.40, and that was $130. And I said at the time that the actual rate of what happened, of the work done in the second period, had to be lower than those numbers because those numbers were averages. So now that we have this, let's take a moment here to compare. What was our material cost in our material rate in the first period? It was $80. What is it in the second period? $72. What is the weighted average between the two periods? $75.60. What was the conversion cost in the first period? $60. What is it in the second period? $52. If we were simply going to take a weighted average of the first and the second period, which is what we do under the weighted average method, that would have been how much? $54.40. Okay? So, now that we have our rates for the work done during the current period, let's go ahead and cost these units right here. Well, I got 200 and I got actually 400 units that were transferred out. 225 of them came from beginning inventory. Well, we already had $26,100 assigned to that beginning inventory. There's no more work that needs to be done in terms of materials, and this is the amount of work that needed to be done with respect to conversion costs to complete them, that remaining 40%, and there's the cost assigned at that rate. So what is the cost of those 225 units that were transferred out? It's going to be this number, these three numbers right here. Then we have 175 units that are fully completed during the period, so they're costed at our full rate of 124, so that's the 2170. So what's the full cost of what was completed and transferred out, the entire 400 units? It's $52,480. And then the 100 units in ending inventory is unimpacted by whether we're using FIFO or weighted average. We've got 100 units. No, I take that back. I'm wrong. We've got 100 units, but these units were started in the current period. and so they're going to be priced at $72. And 50 equivalent units for conversion costs, that's going to be priced at $52. So the cost of our ending work in process inventory is $9,800. Total cost accounted for, total cost to account for. So this last example here illustrates the effect of cost flow assumptions. And as we said, there are various different cost flow assumptions. You look at these things in financial accounting, LIFO, FIFO, HIFO. In the case of process costing or in a flow shop, the only cost flow assumption that is physically possible is FIFO, because you have sequential manufacturing. The first thing into the system is going to be the first thing out of the system. What would be an example of a physical example of LIFO? Well, one I use is, let's say you're at Home Depot and you have a big bin full of nails. So you pour the nails into the bin. People come and they buy nails. Well, they scoop them off the top of the bin. Then you pour more nails in, then they scoop them off the top, so forth and so on. So that's an actual physical flow, actual physical LIFO flow. Okay, so what happens if we include the testing department? Remember, in our costing system here, we had two different departments. We had the assembly department, which is what we looked at in detail, and then we had the subsequent department, which is the testing department. Well, this is very easy because the units transferred out of the first process will be transferred into the second process at their cost at the very beginning of the process. So you would treat that in a way that's very similar, essentially identical to how you would treat the introduction of direct material. Finally, let's look at an example of standard cost. We will look at standard costs towards the end of this course, but for now, standard costs are simply budgeted costs for all aspects of the product. So if we go here to our second period, we have the same information. Notice here that we already have our allocation rates. They're just like normal allocation rates. They're based on budgeted numbers. So again, we go through the same process: units to account for, units accounted for, cost to account for, and then we would account for those costs. The difference is we don't have to calculate these allocation rates because they're given to us. Okay, here's our standard cost rates. So if we're using a standard costing system, what ends up happening? Our output gets costed at that standard cost. So the use of standard costing greatly simplifies accounting. A couple reasons. We don't have to calculate allocation rates. We're going to use our budgeted allocation rates. And more importantly, if we're using standard cost, that means that any product that's in our system will be in the system at its standard cost. So we no longer have inventory layers. If we're using any type of actual costing system, we may have production may cost to make our product in period 1 may cost slightly different than it does in period 2. Why? Because productivity changes, because input costs change, so forth and so on. So we end up with all these inventory layers, and that's why we have to make cost flow assumptions. If we're using standard costs, we eliminate that. Everything that's in our system is at standard cost. Then what hits cost of goods sold is the standard cost of the product. Now, of course, if we're using standard costs, and we'll see this towards the end of the class, we end up with variances in our accounts, and we'll see at that time how we deal with those variances. Okay, that's it for process costing.